Three, two, one. Welcome to the show.
All right. Market's up again. Surprise, surprise.
Yay. I knew that was a head fake the other day.
Yeah. Well, we put out a market update for
On Thursday?
folks on it was Wednesday, I think. Yeah.
Yeah, Wednesday.
And, I actually I have a chart that we did on that.
Yeah, if you remember, make sure you're looking at those market updates. There's a reason they come out, right? It's usually just to kind of put some perspective on a day that seems confusing or it makes something looks like something bigger is happening than really is. And so we try to give perspective to it and, tell us, let you get some insight into which way we think it's going from there.
Yeah. The market's been going up. I don't even know how many weeks in a row now. It's in historic rally. Depending on who you listen to, we haven't had a rally like this since, I don't know, like it wasn't the early 80s. It was maybe coming off in 95, something like that, off of that recession. And at some point we're going to get a pullback. And so, but it's been going up for so long, almost every day, that 1% move that we had down on Wednesday freaks everybody out.
Yeah.
So,
I mean, it is what it is. I mean, at some point it's going to happen. And so when it does happen, just be prepared. That's really what it is. Right. I mean, this is the time to actually be watching it more than you would normally because it's so far off the moving average, and it's we're just it has to correct at some point. That's just a given.
100%, it will.
How much it corrects and how long it corrects for is a whole another conversation.
Right, and you can do projections and things like that, which are valuable to do, but until it actually rolls over, you don't really have a point to extend from. So you can't really say where you think it's going to come down to until you know how high it's been.
Right. Until it hits the high, it's hard to kind of extrapolate what the next low might be.
I mean, it sort of is and it isn't, to be honest. So like in the newsletter this weekend, I'm doing a trend line analysis and a reversion to the mean analysis. And so reversion to the mean is really good because, if you draw a line that basically goes through essentially the center of this rally. So from the October 22 bottom, if you draw a line through the middle of that rally and just look, the price oscillates around that line. And right now we are so high above that line. If it came down, if it came down to 4,800, it would get back to the mean line.
It's a pretty good drop.
Yeah. So it's worth reading the newsletter because I'm going into some pretty good detail about that. But at any rate, on the podcast. So 10 March 2024. A bunch of stuff came out to include today. Wednesday, we had the ADP jobs report, and we also had this Fed speech. And then this morning, Friday, we had the jobs report. So we'll talk about both of those, all three of those, really a little bit. And then, like we said, eventually the market's going to top. And so no one's looking at this right now, but this is the time when you want to look at, in regular TSP, we can't short the market, right? But in the mutual fund window, you can. So I just got a couple of examples of things you can do in the mutual fund window, and a couple of examples of where short selling, like how it works. And then Bitcoin's obviously been on a tear. Every day it seems, and Bitcoin's hard because it's open 24/7. So it's kind of hard to know where you are at any given time unless you actually put it on a chart. And so we're going to look at a long-term chart of Bitcoin, and then the weekly C-Fund chart. Okay, so Wednesday, I think it was, Wednesday, Powell comes out, reinforces his position that the Fed is not ready to start cutting interest rates. How long has the Fed been saying it's not ready to cut interest rates? And the market keeps going up. And it's going up on this expectation that rates are going to come down. And the Fed keeps saying it's not bringing rates down. And the market keeps going up. I'm getting exhausted with this idea of it. It's priced into the market. It's just... It drives me nuts. So he reiterates interest rates aren't going to start coming down sometime this year, but doesn't know when. In considering any adjustments to the target range for the policy rate, we will carefully assess the incoming data, the evolving outlook, balance of risks. Committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. there's a lot of indications that inflation is actually turning back the other way. And so I just cannot understand so the market is disregarding the Fed. It's not pricing it in. It's disregarding what the Fed is doing. We think because of the strength of the economy and the strength of the labor market and the progresses we've made, we can approach that step carefully, thoughtfully, yada, yada. When we reach that confidence, the expectation is we will do something this year. We can then begin dialing back that restriction on our policy. So what happened today? I don't know if I want to go through all this. I really don't. So on Wednesday, you get the ADP payroll report comes out. 140,000 jobs added. Dow Jones, which is not Dow Jones is a company. It's not the S fund, I think is what people usually. Dow Jones is a company. They do a lot of different things. Dow Jones was the one that expected 150,000. Dow Jones estimates for 150,000. So a little bit less than what they expected. Okay. So then you got today, the labor report comes out, the actual jobs numbers, and they expected 200,000 jobs, and they got 275,000. So you get more employment than what they expected, but the unemployment rate went up from 3.7 to 3.9. And a lot of that, I guess, is they were talking about there's an overinflation in January because there's seasonal workers and things like that. And then February is kind of important because it sorts out the overinflated numbers from January. And so the market's up again today, which absolutely boggles my mind. It just on the positive side, in terms of getting a rate cut. So if you're looking for a rate cut, you want unemployment to go up, which it did from 3.7 to 3.9. At the same time, if companies are putting more people to work, how the unemployment rate goes up when, you got more than expected 275,000 versus 200,000 came into the workforce. I don't understand how the math works. I mean, I'm not a mathematicist, but it's baffling. Anyway, so the bottom line for us is it doesn't matter why. At some point, the Fed will cut rates, and it's very possible that at the point they cut rates, it's because something broke in the economy and the stock market's tanking. That's not when the market's going to go up from here. Then it will truly be priced in. All right, short selling. So a lot of people have a hard time with short selling, like you're betting against America. Basically, people that trade, they don't care if the market's going up or down. They just need to be able to see a reason why it's going to go in one direction or the other and just position that way.
It goes back to the fundamentals we always talk about. The best way to invest in the market is to know the trend, right? Yeah. So if the trend is up, you have a plan. If the trend is down, you have a plan. Our plan when the trend is down, the only option we have outside of the mutual fund window, which Jerry's getting ready to explain, is to go to G, right? Because we go cash, which a lot of other people do if they don't feel comfortable shorting something. Yep. But there is fundamentally nothing wrong with shorting a stock. It's different than shorting a company, right? When you're shorting an index, it's not exactly the same. Like when you short a company, what you're doing is actually buying a bunch of their stuff cheap so that you can get it cheap. So you're owning more of their company. Right. So there's a negativity attached to shorting that really has more to do with like how it worked back in the 90s and 2000s when someone would come in and do damage to a company. Yeah. Because you're actually buying the company at a cheaper rate and selling it at a higher rate. Yeah. And making cash off their downfall. They're down. Yeah, right. Decline. And so that's probably not, so when you see somebody like Tesla. Yeah.
I got Tesla as an example.
Yeah. Why can't I think of his name?
Elon.
We say his name 50 times a day.
Elon.
I haven't had any coffee yet this morning.
Elon Musk.
Yeah, when Elon gets angry at someone for shorting, it's because they're shorting his company. Yeah. That's not the same. So I just wanted to kind of point that out for some, because a lot of this stuff is about perspective.
Oh, yeah, it's all.
And and it's about the details. The devil's in the details. So if you start listening to people talk about a particular topic on Bloomberg or CNBC or something, you have to have it in perspective to know what they're talking about. And so I just kind of wanted to point that out when Jerry goes into this idea of shorting. Really, all you're doing is taking advantage of the trend that at this time is going down. You're not so much shorting a company,
Right.
so it's
right.
not the same effect. So just kind of wanted to point that out.
Yeah, that's true in indexes. So if you are so inclined to short, how would you do it? This is definitely the book you want to start with. William O'Neill was the founder of Investors Business Daily. And,
Did you take that picture?
I did. Can you tell? I had no better way to do it.
Sorry. Just giggling because the lights.
He's laughing about this. Definitely. Yeah, I'm not tech. You can tell I just took the picture on my phone.
I'm happy you
emailed
got
it to
the
myself.
white background and everything.
Yeah. So definitely, I've read this book a lot, and I keep going back to it when the market's at a high like this to get an idea of what I think I want to do. So just a couple of examples. Tesla was a good one. Elon probably would not want people shorting his stock, but shorting is really, really tricky, right? You could say we have this big blow off top, and so definitely, Tesla's getting ready to crash, and I want to short it up here at the top. It's impossible to know where that top is actually going to be. And then 9 times out of 10, you get a big move down, but then it comes all the way back up. So what O'Neill does in his book is the idea is you want to watch, and when the 50-day moving average line, which is this blue line, and the 200-day moving average line is the black line, okay? So when the 50-day crosses down through the 200-day, there's something seriously wrong with that company, right? So that's really the first. You want the 50-day to cross down through the 200-day. And then it recovers back up, does some churning here, and breaks down again. That's the point where you want to short it, right? That's the highest risk-reward level. It's much more likely the market continues down from there than it turns around and goes up. Because we've already established that the company's in trouble when it crossed the 50 crossed the 200. And then it recovers, gets some churning, and then breaks down again. That's the point right there. Another time to do it, we had the cross here. It pulled back up, but couldn't get above that 50. So when it broke down that day, a couple days ago, that was a great day to short Tesla. So just an example of kind of how you would do it. And then Apple is another one. So, and I mean, these two are easy examples of shorting, but they're also two of the Magnificent Seven that are now basically off the list. So the generals, as they say, are falling, and it's not good for the overall index. So Apple, you got crossing the 50 crosses the 200 back here, a big recovery rally, and then so it never did this churn that we were talking about before. No problem. You still got lower highs. So the company's still in trouble. It breaks down again, comes back up, can't get above there, some churning, gaps down. That's a great time to short it. Over here, we're just looking for another cross down for the 50 to through the 200. So even though we got a big move down already in Apple, it's very likely that we get a cross somewhere, possibly by the end of this week. The market is going to rally back up because it can't. It's way oversold right now. Rallies back up, and when it gaps down here, that'll be another great time to short Apple. So a couple things to put on your radar if you are in a brokerage account, and you can short sell companies. But in the mutual fund window, so there are 3 of them that I just wanted to kind of go over real quick. SOPIX. If you think the NASDAQ 100 is at a peak, or when it gets to a peak, it's going to be a good short. And so these are inverse ETFs. So it does the same thing as shorting. It's the reverse of the index. So in this case, it's the reverse of the NASDAQ 100. This is the reverse of basically the S fund, small caps, and this one is the reverse of the S&P 500. So here's the inverse of the NASDAQ 100. So all I'm doing is watching this chart, right? Same thing we always talk about. You got relative strength increasing as price is continuing to decrease. So at some point we're going to get a bottom here. At some point we're going to get a bottom here. When it ticks back up, that's when you would buy this ETF in the mutual fund window. And as the as the Nasdaq went down, SOPIX in the mutual fund window would go up. Small caps. So if you've been following the certainly the newsletter, the small caps have been in this range, right, for a long time. We had a breakout. So this is the inverse. So when we had this breakout, the S fund was doing well, right? When this is going down, it means the S fund's going up. So the S fund has been doing pretty well. If you think the small caps S fund is getting ready to go down, you would buy SHPIX, and as the S fund goes down, this will go back up. And then the S&P 500, same kind of idea. This is the inverse of the S&P. We had the peak in the S&P 500 in 22, so we had a low, right, in the BRPIX. And then 2022 had a pretty good, I mean, it's a pretty good move from basically 13 to 17. It's a pretty big percentage gain if you were in that in the mutual fund window. And so as you're watching the S&P 500, once it peaks and starts to decline, that would be the time in the mutual fund window to buy BRPIX. And there's a ton, I mean, you can get inverse, it's pro funds. So if you go to the mutual fund window, you go into the, there's a tool in there that lets you sort through all the different companies. If you sort it by fund, pro fund is the company. It's the company that builds all these different inverse mutual funds. And so if you just go in there, there's like 4 pages of pro fund funds that you can get to short pretty much anything you want. Okay. Bitcoin. I'm putting this in here, because Bitcoin has been really on a tear since the beginning of 23. So if you wanted to get into the Bitcoin trade, basically, this is how you would do it. You can do it in the mutual fund window. Obviously, we can't do it in regular TSP, but if you wanted to be in Bitcoin, BTCFX is how you would do it in the mutual fund window. It's not an inverse. Obviously, it tracks the price of Bitcoin. Okay, so if we're talking about Bitcoin had some giant moves, right? 3 giant rallies really since its inception, and they've all peaked out in the range where we are right now. Okay, so it doesn't, not to say that Bitcoin is going to roll over from here. It certainly could. If it gets below the lower line, it's likely to keep going lower. But if it breaks out above this higher line, that's when they're talking about potentially 150,000 a coin this year in Bitcoin. So I don't think I have a daily chart. I don't. But if you looked at a daily chart of this, there's a lot of churning in this zone right now, because the market's trying to decide if it's going to break to the upside, if it's going to roll over like it has, the last couple times. So the daily moves in Bitcoin aren't as important as to when it gets up here, say 69,000. If it broke above 69,000, we would have gotten past this overhead resistance, and it likely keeps going higher. Okay. C-Fund chart. So like I said, last week we put up in a market update to subscribers this chart. So why did we do this? This was the day that we put out the market update, right? It was a big down day for the market, and I was getting a bunch of email and texts about, hey, is this the time to get out? And so what we put together was kind of what's happened the last 3 times, at least since January. So you get a run up in the market, you get a reversal day, one big down day, and the market continues on to new highs. Okay, same thing here. Market's going to new highs, reversal day, one big down day, and the market keeps going to new highs. And then this week we got the same thing. Market's at a new high right here, reversal day, one big down day. Okay, so that was on Wednesday. The point of it was now is not the time to get freaked out about one big down day, because we've seen this play out the same, at least since the beginning of the year. And then so if we go forward, this was that big down day, and the market goes on to new highs. and today it's actually higher. So it's continuing to go to new highs. So it doesn't mean that you should be complacent and say, well, the market always goes to new highs. At some point, this is going to be the beginning of something, right? If this day had closed down here below the 20-day moving average line, it's a much different scenario. But until we get a close below that 20-day moving average line, since we had this breakout in November, every time we get to that 20-day, we get support. So until we get below there, there's really nothing to talk about. The market just keeps going higher. Okay. Weekly, a couple things to point out. So like we said before, we are really extended above that 20-week moving average line. I mean, if you go back anywhere, in the 21 bull market, we were pretty high above it here, but nowhere near like this distance. I mean, that's a big percentage drawdown. If you're following this on a weekly basis and you're only making decisions, what you would do is you would wait until on a weekly basis you get below the 20-week moving average line. But that's a huge decline. So you have to keep that in mind if you're only trading weekly. But what does it look like? So we've been showing this example a lot. When the market peaked going into 22, price was going higher, relative strength was declining over that same time period, and CCI was declining, and MACD was basically flat. Right now, you got RSI, it's high, right? It's overbought, but it's staying there. CCI is flat, above 100, and MACD is expanding to the upside. So on a weekly basis, there's nothing to even talk about. The trend is up. I mean, that's it. The only other thing I would point out on this is rarely do you get this orange line right here is the moving average of the relative strength. And very rarely do you get the moving average itself. So in this case, the moving average is 70.46. Anything above 70 is overbought. For the moving average line to be overbought on a weekly basis is unusual, right? It's not going to stay up there all that long. It doesn't usually get there, right? Back here at the top of that 21 rally, we saw that, right? The moving average, let's see, right there. The moving average of the RSI got above 70. And we're above there right now. So could we have, a couple of more months of price movement to the upside? Yes. But most of the time, you don't get that orange line, that relative strength line above 70. It's really, really, really overbought. That's what that means. So again, the bottom line is that there's no reason to freak out right now. The trend is up, but it's not going to stay up forever. And usually when things go up to extremes like that, they come down to extremes. Okay. All right. That was all I got. Questions?
What do you mean that's all?
There's a lot of stuff in there.
That's enough.
I know. The bottom line is the trend is up, and that's great. And you want to be in the stock funds when the trend is up. And you can't, there's no point in trying to anticipate when it's going to roll over, because that will force you to do things that are emotionally driven.
Yeah.
It amazes me that the market's going up. But
the only caveat I would put to that to say is, getting into this time of the year that we're at, let's say you're going on spring break with your kids or something like that, and you feel more comfortable locking in your gains, if you want to use that term, and going to G and going on vacation, do that. Like, that's really the only time that if you asked us, when is a time when the market's going up that you would do that would be the time. Like, don't stress over this stuff. Definitely don't be on vacation with your family stressing over whether the C funds are going to roll over.
Right.
Like, it's not worth it. You can get right back in,
Right.
So anyway, that'd probably be the only caveat that I'd throw out to that.
Yeah, I'd have a very hard time going on a vacation and completely turning off the market right now and being fully invested in the stock funds.
And being in it, right? Yeah, that's the point. If you weren't in it, or whatever, but where we're at, you don't, because you're going to be looking at it because you're going to be worried about losing money.
Yeah.
And you should enjoy your your time. And so that's the only caveat I throw out to that. But other than that, no, there's just, we're on a trend up. You ride the trend till it's done.
Yep.
And then when it's done, we're
That's
done.
It's the hardest thing because there's so much out there about why the market should be rolling over.
Yeah. And there's plenty of reasons why, but it's just not.
But it's not.
We talked about this yesterday, how the market's going to do what the market's going to do. It doesn't really care about you.
Yeah, 100%. Doesn't care about you, the Fed, like anything else. It's just rolling.
Yeah, it's going to disregard what it wants to disregard. Because at the end of the day, it's humans making these decisions. And although humans give patterns, they're also not always predictable.
Yeah.
So hope you guys got a lot out of the show. If you enjoy it, please share it with your friends. Hope you guys have a great week. And we will see you later.
Out of here.